In order to track the transactions in an economy, we use the circular flow diagram. Almost all countries calculate a set of numbers known as the national income and product accounts. The national income and product accounts are used to track the transactions in an economy. The circular flow diagram is a visual representation of the transactions in the economy. In a very simple economy, the transactions are connected through two sectors of the economy. The first sector in the economy is households. Households are defined as individuals who share income. The second sector of the economy is firms. Firms are defined as producers of goods and services. If you think of the circular flow diagram as a swimming pool, we can track the water coming out of the pool and through a pump and then back into the swimming pool again, and hence the circular flow. The circular flow of an economy works exactly the same way. We track the transactions or money flowing in exchange for goods or services produced. In order to produce those goods or services, firms must hire factors of production. Those factors of production are hired in the factors market. Our factors of production hired from households are land, labor, capital, and entrepreneurship. In exchange for those four factors of production, the firms pay household wages, rent, interest, and profit. Those are the returns on the four factors of production. Wages are exchanged for labor. Rent is exchanged for land. Interest is exchanged for capital. And profit is the return on entrepreneurship. These four factors of production are owned by households. Households, in this very simple view of the economy, are the only owners of the factors of production, and hence the incomes flowing through the factors market flow to households. We know in reality that this is a simplistic view. We know that firms can own factors of production such as land and capital. But in our very simple view of the economy, we are starting with the assumption that households are the only owners of factors of production. In the circular flow diagram, then, this is one side of the loop, the factors market. Imagine this as the water flowing out of the swimming pool and into the pump. The water then would flow from the pump back into the pool again, and that is our other side, or the market for goods and services. In exchange for goods or services, the households must pay for those goods and services. When households purchase goods and services, we refer to this as consumer spending. And if you imagine all the water flowing through the economy as gross domestic product can be added up from households and from firms. On the other hand, we could also add up gross domestic product on the opposite side as well, and this also must sum to gross domestic product in our simplistic view of the economy, so that all wages, rents, interest, and profit would sum to GDP as well. The two sides are equal. We have two different ways of adding up gross domestic product. One is through all incomes, and the other is through all spending. In our very simple view of the economy, consumers are spending and firms are spending. When firms spend, we refer to it as investment spending, so that gross domestic product can be summed up through all spending in the economy, through consumer spending plus investment spending. Now we want to add a third sector of the economy. The next step in the circular flow diagram is to examine income by households. Households do not necessarily spend all of their income. As a result, the income flowing into the household can flow out as consumer spending and private savings, so that we have the equation income is equal to private savings plus consumer spending, where C stands for consumer spending and S private stands for private savings. There are two things households can do with their income. They can either save it or spend it. When households save part of their income, private savings flow into institutions in financial markets referred to as financial intermediaries. Via financial markets, private savings are channeled into investment spending by firms, where households are the suppliers of financial assets in the form of savings, and firms are the demanders of financial assets. In order to make investment spending, 90% of investment spending in the United States is done on borrowed funds. So as a result, in order for firms to engage in investment spending, in this model, firms demand financial assets or borrow from financial markets. Two forms, either through the issuance of stock, where stock is ownership in a share of a company by shareholders, or through bond issuance, where a bond is an IOU that pays interest. In our very simple circular flow diagram demonstrated thus far, we have households who can either spend their money or save it, and that money is in the form of income flowing from the earning of wages, rents, interest, and profit, earned on factors of production which firms hire in the form of land, labor, capital, and entrepreneurship. Households and firms' total income is equal to gross domestic product, or the sum of all domestic production in a country. In this simple view of the economy, all spending is represented by consumer spending and investment spending. We can represent the GDP equation with the variables C plus I, where C is consumer spending and I is investment spending. Our next step is to expand the economy further and introduce government. When we expand the economy to include the household sector, the firm sector, plus the government sector, we have added an additional sector of the economy. Government engages in government spending in the form of government purchases of goods and services, and government receives funds in the form of taxes. In this very simple view of the economy, we represent households being taxed by government. The sources of government revenue we will see later on. In addition to households, government also receives revenue from firms and the rest of the world as well. In this very simple view of the economy, money flows out of the government through government purchases of goods and services, and money flows in to the government in the form of taxes and government borrowing when taxes are insufficient to cover government spending. We add a fourth sector to the economy at this point, represented by the rest of the world, so that now we have our complete view of the four sectors of the economy representing our equation for GDP. To our simple circular flow diagram of households and firms, we have added government and the rest of the world, plus financial markets. Our four sectors in this economy are government, households, firms, and the rest of the world. The spending flowing through the market of goods and services represents the GDP equation. In addition to consumer spending and investment spending, we have added G, the variable for government spending on purchases of goods and services, and the foreign sector. The foreign sector is represented by exports minus imports, where exports are goods produced domestically and sold abroad, while imports are goods produced abroad and purchased domestically. Therefore, in our equation for GDP, we add exports and subtract imports, since gross domestic product represents all goods and services produced in a country, and imports are produced abroad. In our full view of the economy, we have represented gross domestic product as all spending in the economy, which is equal to all income in the economy. And both of these can be represented by equations. The GDP equation is equal to C plus I plus G plus X minus IM, or imports. On the income side of the economy, we represent the factors of production. Funds can flow through financial markets in the form of borrowing and stock issues by firms. They can flow from financial markets into government. And finally, funds can flow in the form of foreign borrowing and sales of stock, and foreign lending and purchasing of stock. This completes our circular flow diagram.